Firstly, I'd like to thank Iqbal for giving myself and AM Best the opportunity to have the prestigious position as the keynote address here today within the International Takaful Summit. So what I'd like to discuss over the next 30 minutes is I'd like the audience to think about adaptability and sustainability of the model. The Takaful market has developed significantly over the last 10 years, and I feel we come to these conferences and we're trying to find that unique solution in terms of the perfect Takaful approach, and we're still yet to find the right balance and that right approach there. However, there are some notable successes that we see across the world. In Africa, there are companies doing well. Even in Palestine, there's a Takaful company there which is generating good returns, in addition to Malaysia and some GCC companies as well, showing good returns coming through. So, firstly, I'd like to highlight, so those are just disclaimers, we can skip over those. So, from a ratings perspective, I don't want to bore everybody with a lot of methodology, but it's important to understand where we come from as a rating agency. And we have a specific dedicated criteria for Takaful because we believe it is different and it needs to be treated in a different and a unique manner than other companies. It is there for a purpose, like with mutuals, etc., to deliver. So these are the key components that we look at. We are not Sharia scholars. We are not here to assess how Sharia compliant an insurance company is. We're interested in how Sharia compliant they are, but we're not here to assess, what they're doing, etc. But what we are good at and what we are interested in is assessing the financial strength of these companies and their ability to meet their policyholder obligations. So when we look at balance sheet strength, we adopt a two-tier analysis. We look at it on a combined basis, but what's more interesting is honing down on the policyholders fund and the amount of surplus which is generated in that fund to support the risks that are inherent there. When we look at operating performance, yes, we look at the investment side and the underwriting side, but it's key to understand the balance between what's being paid to the shareholders and what's going out to the policyholders as well. And on business profile, yes, the profile of Takaful companies are not, say, advanced as conventional markets, but we do appreciate it is unique and we have to look at within that segment as well. Overriding all of this, we also consider the ERM approach, how it binds balance sheet strength, operating performance and business profile together. And given the nature of where a lot of the Takaful companies are based, we also overlay that with our country risk assessment. So I'm not going to have time to go over all of these, but I'll touch upon these points as we go through. And when we consider all of these, then we come up with the overall rating. So the most important thing, I believe, to consider, and I've shown this in previous presentations as well, is why do insurance companies fail? If you know why insurance companies fail, then hopefully, companies can address these issues and make themselves more robust over time to accommodate them. Unfortunately, off the legend, the bottom one, the most important one, is missing. And the main reason why insurance companies fail is basically down to the underwriting side. So it's primarily mispricing of the risk or under-reserving of the risk. We've seen a number of adjustments in the Middle East markets with the Saudi Arabia and the UAE going through their actuarial reviews on the pricing and reserving, and I think that's good for the stability of the market. And that's addressing one of the key issues here in terms of making sure that you have a sound insurance environment to work with. In addition to that, you've got growth as well. Growing too fast, and I'll talk about that a bit later on, can be to the detriment of companies. We see high growth markets, particularly more so in Asia and the Middle East, more so than the mature markets given the current environment. But is it a good thing to grow into markets that are growing strongly but the profitability is not there? So other reasons there, problems with affiliates, shareholders, catastrophe losses, having too much concentration in a particular reinsurer, or having problems with investment. I would say when we consider emerging markets, there would be a higher degree of risk on those other elements over and above, say, what we see on the in addition to the underwriting side as well, just given the composition and the business that they are writing. Now, I think it's useful. Now, we'll concentrate on Takaful in a little while, but I think it's nice to understand what's going on in the insurance industry, what we see from a ratings perspective, And while it affects insurance companies, we believe it also affects Takaful operators as well. So I know the next slide is quite busy, but I find it very interesting in terms of what has happened to the insurance market over the last 10 years. Now, this isn't exhaustive, it's just an example. So on the top half, you'll see on the insurance side, what are the risks that the market has to face. So you have the storms in Europe, Storm Klaus, Kirill, etc. And then you have the big storms in the US. So you have the cat losses which have come through in 2011, 2012, the Thai floods, the earthquakes, etc. So the insurance market has gone through all of those. In addition to that, you've got those big, large losses on New Year's Eve a couple of years ago with the address loss, which affected the Middle East market, but it more affected, say, the reinsurance market because a lot of it was put out into the market. And more recently, the tower not too far away from here on there. So you've got these single large losses, you've got these cat losses, and also you've got the reminder of things like Ebola, SARS, the Zika virus, which weren't really any industry events, but just serves as a reminder on the life side that, you know, there could be a potential pandemic out there if we cannot react in time to find solutions, medicines to such diseases. Then there could be a material risk there which could have accumulation and knock-on effect. So the insurance industry has had to deal with insurance events, but they've also had to deal with other events as well. And this, I'd say, gets less attention, but I believe is just as important, and is just as important from a credit perspective. So if we look back in 27, we have the subprime crisis, we have the Lehman Brothers bankruptcy, we have the Greek bailout, followed by the Arab Spring, which is still ongoing today. And as a consequence of all of these events, we've had sovereign downgrades. Not just in mature markets, we've seen a higher impact, say, in emerging markets. So sovereign ratings have moved down a lot more. So we've had then the recession in Europe, the slowdown of the economies, depressed oil prices, which I'll come on to, and more recently in the previous session we've discussed Brexit. You've got elections coming up in Europe as well. They had it in France, they've got Germany, Italy coming up, and in addition to that we've got the conflict that we've recently seen with Qatar and and part of the Middle East. So got all of these things bubbling along in the background, and you know, as a result of what we see here in London, we've had the depreciation of the sterling currency. There's a lot of discussion about what inflation is going to be like going forward and how that's going to affect, say, the reserving practices of certain companies, particularly on longer tail lines going forward. So we've had the liquidity crisis, we've had a sovereign debt crisis, we've had a low interest rate environment. I think if you were looking 10 years ago, how many of us here today would have predicted this to happen and what the insurance industry has had to go through. But in the event of going through this, I believe that the credit quality of most companies in the mature markets, in addition here with Solvency II, they're probably in a much better position. They've improved their risk management practices in that period of time. In emerging markets, I would say less so. Yes, some have developed, maybe some have moved in the opposite direction. So what does that mean going forward? What is going to be the big challenges and the big risks over time? Now, I won't go through all of these, but it's just to highlight, you know, what are companies looking at? Where do they see as a big risk to their operation or big opportunities to their operation, and how are they going to tackle it? So we've got the insurance risk, which we've talked about. We've talked a bit about the economic risk as well, and I'll come on to that as well. But there's also the technological advances, the innovations that we are seeing in the market. Is it going to change distribution that companies are using? Are they utilising data more, telematics and those type of things? Is that going to be a game changer? And a lot of companies are investing in technology. Is it to be there, or is it because everyone else is, and if something does happen, they want to make sure that they remain relevant in the market? So I think it's difficult to predict what's going to happen going forward, but companies' ERM approaches should be looking at these areas to make sure that they are prepared for these elements. What is the most significant? Insurance, political risk, economic, technological, or is it something else which is out there? So if we move on, oil prices. Now, we've seen oil prices drop dramatically. Very few would have predicted that it would have gone to about $30 or $35 a barrel in, say, the early 2016. Why is that important? I think oil is probably one of the most important commodities out there. whether you are operating in mature markets or emerging markets is important. It's what's kept a lid on inflation in mature markets, but in emerging markets, a lot of them are very much dependent on oil. And if we take a look at the next slide, we'll see that 50% of oil production comes from emerging economies, mainly out of, say, Middle East, Eastern Europe, Africa, and even, say, Latin America. And given the severity of the way oil prices have moved, we'll see on the right-hand side of the chart the fiscal break-evens. There was talk earlier by Alberto about the oil prices, etc. And this is creating a significant strain on these economies. You know, when it was, say, $80, $90 a barrel, it wasn't a problem. They were generating lots of income. They could invest that in their countries. Now they have to think twice about it. You know, they're not getting those revenues coming in. While the GCC have surpluses, well, most of the GCC countries have their surpluses, and they can accommodate that over the short term. Over the medium to long term, they are going to feel further strain down the road. There has been, say, a cutback on the infrastructure spending in these countries, and as a result of that, the economic development slowdown will be there, and that's going to have a knock-on effect on the insurance industry as well. So, linking it through a bit more is that this is just a graph to illustrate oil prices relative to the stock market. Now, why is this important? Well, when we look at the GCC, there's a significant concentration in companies' profiles in terms of equity investments and real estate investments in the market. So generally, when you have a shock to the market, it's going to ultimately affect the stock market performance as well and add volatility into companies' operating performance and balance sheets that they have there. So while it's not been as severe, you know, I would say there is an element of correlation there. And we've even seen, due to the conflict with Qatar, how the Qatar stock market has reacted in relation to the issues there. And if we were to take that one further, and we've not discussed that yet today, is the impact on currencies, particularly in emerging markets. So we've seen the oil price come down, but in a number of countries, you know, we've also seen currency depreciations and in some cases currency devaluation. So those economies which are very much dependent on oil to generate revenues, in addition to that, having currency depreciations, the insurance companies in those markets have had a tough time, and we've probably seen that the credit quality of those companies have been reducing. So while the GCC countries their currency is pegged to the US dollar, while the fiscal strains continue, there is the chance, an increased probability that those currencies could be unpegged over time. We haven't got Malaysia here, but Malaysia has also suffered from depreciation of their currencies, which insurance companies have had to deal with. So if we move a little bit more onto the Takaful side, and it's been discussed by Alberto in terms of where we are in terms of the Takaful segment, and penetration of Takaful is not, say, where it is of Islamic banking. We're saying Islamic banking is not where it wants to be, but Takaful is further lagging behind there. But we see that, say, the penetration of Islamic banking in the Middle East is more robust than, say, in Malaysia, but on the Takaful side, it is significantly lagging behind. And when we come to compare these markets, say Malaysia against the Middle East, and we're trying to say who's doing well, who's not doing well, you know, I think we need to look at the profile of these markets, and they're very different. Whereas Malaysia is more on the life side, and they're distributing their products through a bank assurance channel. On the Middle East side, the life market is basically, or say the Islamic life market, is basically non-existent, and everyone is focused, most of the companies are focused on the non-life side. Now, if you look at I believe there are significant opportunities in North Africa where there is a vast amount of population. So if the wealth of those countries do improve, then we could see the take-up of more life products in the market. But when we look at the GCC, life products is generally for an expat market, which are taken by the more international players in the market. So generally, you don't see them in their statistics. But what's also important is that a lot of the local nationals in the GCC are getting benefits from the state. Now, with the way things are going, with the oil prices strain on the countries and fiscal balances, etc., we may see a change in the dynamics of these markets, which could open up the life segment on the GCC side. So we talk about the top line 20 billion contributions in the Takaful sector. I think sometimes we eliminate Iran from there, which has about $6 billion of premiums. But what I find interesting is what physically ends up within the Takaful or re-Takaful space. So we all talk about gross contributions, but what about net contributions? What about the reinsurance side of things? So generally, what we are seeing, yes, the markets are growing. It is coming into the Takaful sector, but when it comes to reinsurance, re-Takaful, a lot of that business is being ceded to the conventional markets. And even if it is being ceded to a re-Takaful player, they're probably buying retrocession or retro re-Takaful with reinsurance companies. I think the disclosure of information on the re-Takaful sector is quite limited. A lot of the global reinsurers, in essence, have branches there, so it's difficult to track the information. But what we do find is that when it comes to corporate, big, high-value risks, a lot of these generally end up in the conventional market, and maybe, say, the motor, maybe a good slice of the medical and life business are probably staying in the Takaful segment. It's just something to think about. So I'm not going to go through all of the market challenges that we have here. I think all of them are very much important to Takaful players in there. One thing of note is the VAT, which also was mentioned earlier. That will come supposedly into place on the 1st in January 2018, although they say it could be delayed. What's of a concern to us is more from an ERM approach, that companies are not proactive and looking at the implications of VAT and what it will have on their claims experience profile expenses. But another thing I will touch upon, because I know the audiences are generally interested in it, is on the M&A and what we see on the M&A side. So there has been some action when it comes to mergers and acquisitions. So if we take the right-hand side first, where we have the Middle East, so you'll see some, I would say, some quite unique acquisitions there. You have First Insurance of Jordan, which is Takaful, acquiring a conventional company in terms of Yarmouk Insurance and then converting it into a Takaful company. You have Bahrain Kuwait, which is a conventional company, acquiring Takaful International, which is obviously Takaful. And on the other side, Solidarity acquiring, say, Al Aliyah of Bahrain, which is a conventional company. So you've got, say, conventional companies acquiring Takaful, whether they want to get into the Takaful field. You've got Takaful players acquiring conventional, and you're also seeing a bit of switching in terms of licenses there as well. We've also got the issue of the Saudi companies and the regulator taking action, and those underperforming companies are having to consolidate their operations together, so we'll have to see how that develops over time. And we're still seeing new entrants into the market with, say, Orient UMB Takaful recently formed this year, say, a joint venture between UNB Bank and the Al Futain Group in the UAE. And on the, we've also seen, say, portfolios being run off in terms of Takaful Re, and we saw a few years ago, say, Al Baraka Insurance in Jordan. So I think it's quite interesting, the landscape in Takaful and what's happening in the Middle East, but you're seeing local companies acquiring other local companies, whereas in Malaysia, I think you've got more. I think the potential there is more, and you've got international players getting more involved with Zurich acquiring M&A for, say, a wider platform into not just Malaysia, but the wider region. And there's been some news in the press about, say, interest in Sharia Takaful and, say, Allianz and HSBC Amana. So I think that's an interesting aspect to also look at. So if we move more over into the Takaful space, then I know there's a lot of negativity out there in terms of are companies doing it right. But I just want to give a few examples about two companies which may not get it perfect, but are probably doing a better job than what we see a number of the companies in the market. So this is Abu Dhabi Takaful, National Takaful Company, and you'll see that their capital surplus is growing, their gross and net premium is growing, they've got excellent underwriting income coming through, a very conservative investment policy, and they've been paying out shareholder dividends since 2012, but they've not paid out any policyholder dividends at present. exceptional loss ratios and combined ratios in a market which is extremely competitive, and a number, the key lines of business are quite marginal with exceptional ROEs in the market. So it just shows, overall, when we look at Takaful compared to conventional, that you can make it work and you can generate profits from the market. They're probably one of the best relative performers in that market. Another example is, say, Qatar Islamic, and I know there's a few colleagues from Qatar Islamic here today. Again, a similar story, capital and surplus developing, their profile developing the market, good underwriting results, more volatile investment income due to their profile. They are paying shareholders' dividends, but they're also paying policyholder dividends. I've not put the level of dividends there. You can ask Mohammed afterwards if you want more details on that in case it was public information. But they've been going from the 1990s, and they've been making a success of the model with good returns and a reasonable balance for the shareholders and the policyholders. So I'm not going to give any examples of companies that aren't doing it well. I'm sure you can probably find ample out there for your interest. So what do we see from a business profile perspective? I think it's key to understand how companies are differentiating themselves, whether it's from distribution or product, and that's key to make Takaful a success. So what we are finding is that a lot of companies are competing with conventional insurers in the market. The new entrants or existing entrants that have been there for the last, say, 7-8 years, I find it difficult to establish themselves in the market. They don't have the brand and they necessarily don't have the reputation in the market. The markets are very competitive. They have to compete on pricing. They don't have the expense scale that some of the other companies have in the market. And we don't really see them having the franchise, the brand that some of the other players have. Some can with their uniqueness, but they are finding it difficult to show that they have some sort of value added advantage over some of the other companies in the market. And in addition to that, I'll come over to management at the end, but there is a lack of skilled professionals in the market, and that is key to make things work there. Moving over onto the operating performance side, which I think is very key and probably, I would say, the most interesting part that we have, is to try and understand the balance of earnings between the shareholders and policyholders. And I think this is a key challenge to the market, and it's a key challenge to credit ratings that we have out there. So the ability for the policyholders fund to generate surpluses. So sometimes companies can be doing a fantastic job, but if they haven't got the mechanisms right, if they haven't got the right charge on the wakala fee, they could have combined ratios as 80%, but the policyholders fund could still be in deficit, which then creates a dependence on the card Hassan. So I'll go through these with a few examples, but it's important for companies to adopt a suitable model so that they can show that they can create surpluses within the fund and that they have the appropriate structure to the benefit of all. So when we look at, say, the UAE market, so this is just taking an extract of companies. So here we've got another company there, Arab Scandinavia, which was conventional and has been converted into Takaful as well. But you'll see the loss ratios, and apart from AD&T, the rest of them are generally on a par with the rest of the market. So the red line is just showing the mean. It's not a weighted mean. It's just a standard mean of the market in the UAE. And yes, there are some above, but most of them are on a par. So maybe the underwriting is fine. And I would say this is indicative of generally Takaful companies that we see in the region. But the big issue is at the bottom on the expenses side. They haven't managed to reach the relevant scale. So this is actual expenses. It's not wakala fees going in there. And while some of them are online, I generally think that this is the main issue that they need to address on the expense side. And that's part of that is down to access to business, trying to achieve the scale, etc. So this basically translates into weaker combined ratios and weaker ROEs than we see of a number of their conventional counterparts. And to make things a little bit more interesting is how we see the development of the wakala fees. So this is just a basic comparison between Malaysia and the Middle East markets, and we see, the wakala fee is expenses plus the cost of capital, and we see that in Malaysia they are a lot more prudent than, say, in the Middle East. In fact, in the Middle East, the discrepancy between the level of expenses and the wakala fees has been broadening over time, and that is a concern. having that divergence there, and ultimately that creates higher dependence on the card as hand. So as we see in the following slide, is that generally from the models that companies are approaching, and this isn't the case for all companies, but is the general case, is that the shareholders are benefiting, their policyholders' funds are in surplus, and you'll see that green line going across is the dependence on the card as hand, which has been increasing significantly over time. How are they getting around that? Well, regulators are trying to impose restrictions in terms of what can be charged at Wakala fee, but I believe the onus should be on the company to make it work. So companies do need to adopt a suitable model, and that is critical to make the overall workings relevant. In terms of the investment composition, so again, when we look at Malaysia, they're more on the life side. The Middle East are all more on the non-life side, but there is a higher concentration of invested assets in, say, equities, real estate, which are less liquid, whereas in Malaysia you've got high concentration in cash and bonds. Now, Malaysia does have a much bigger, larger bond market or sukuk market out there, but again, it's just showing another disparity with the profiles that we have, and it is a concern because the Islamic finance markets are not as developed, the opportunities are not there to diversify, so we do see significant concentrations between asset classes and counterparties within the Takaful segment. So overall on the performance side, what we are seeing is that Malaysia are generally doing a much better job than the Middle East markets. The technical performance is positive generally for Malaysia, whereas it's negative for the Middle East. The Middle East are dependent on investment income to generate earnings. So just quickly, I'm conscious of time, to say a few words about balance sheet strength. We do a two-tier analysis on the, so we run our capital model on both on a combined consolidated basis and on the Takaful fund, and it's important us to understand in terms of the regulatory environment and what the regulation affords in terms of the shareholders supporting the participants' fund. So if we believe it is strong enough, then we can give them credit for the assets that are sitting in the shareholders' fund. When we assess in the Takaful fund, generally what we're seeing, as we've seen with the dependence on the card Hassan, low surplus accumulations and the high wakala fee impede the development of surpluses, which means it is generally weakly capitalised. Apart from Pakistan, where I believe the regulator enforces that you have to put all your capacity with Takaful, other regulatory regimes are a lot more flexible, so companies tend to use reinsurance, and from what I've seen, they like to use traditional reinsurance because they give in that little bit extra to them in terms of service quality, which they generally don't see from some of the Takaful players in the market. On the positive side as well, they have unleveraged balance sheets as well. So this is just an example of what we see for Takaful in terms of what their main risk criteria are. And whereas when we look at Saudi, where there's restrictions on the investment side, a lot of that market underwriting risk will be driving the capital requirements. And similarly in Malaysia, we'll see underwriting risk driving capital requirements. But for the general standard Takaful players, you'll see that real estate and equities is the main area of concern in what is driving capital, and that can be volatile, so we would expect companies to hold a higher level of capital to absorb some of those risks which are inherent in their profile. We should see that change going forward with the new regulation in the UAE and other countries adopting, say, more stringent regulatory practices in the region. Few words on Saudi Arabia. You can look at this at your leisure, but all it's trying to highlight is what the paid-up capital was in 2011 and where it is in 2016 relative to the level of capital and surplus. So you'll see that the market is running generally losses up until 2011. In 2016, we've seen a massive capital injections into the Saudi Arabian market. I think they've increased paid-up capital by 40%. 3 companies have actually increased their capital and then reduced the amount of paid-up capital in the market. And if I flick on to the next one, you'll see the bottom half of the table as well. So things are improving in Saudi at a steady pace, but companies are still suffering. But from a capital point of view, it's not just about putting more money into the company. And given that most of the risk is on the underwriting side, it's also important, I would say, as a very simple measure to look at the underwriting leverage, and that's been very volatile in recent years. Companies growing very fast and then running into difficulty with the actuarial reviews on their reserves, having to take reserve strengthening, adjusting their pricing, etc. So things are getting better, but it is still a challenge in Saudi. I won't talk about ERM in the interests of time, but all I would say is that what we generally see in the region is that companies, invest a lot into ERM, but what we're interested in is, do they understand their risks? What are they doing about it to make their operations ultimately better? So they shouldn't be doing it to satisfy credit rating agencies or regulators. They should be doing it to make their overall operations stronger and more robust. So the last couple of slides is companies need to get the right balance. If they're focusing on growth and not looking after their pricing, the profitability is going to suffer, and ultimately the financial strength of companies will suffer. So, I understand in the Takaful segment you do need some growth to achieve scale to get the expenses down, but not to the detriment of the overall financial stability of the company. So excessive growth can lead to weaker credit quality. That's not just for Takaful, that is for all companies in the market. So I'd like to finish off by saying, so what will happen in the future? Now, if we look at the insurance industry worldwide, it's made up of a variety of institutions. So you have your traditional companies, you have mutuals, you have P&I clubs, you have pools. So there is no reason why you cannot have, say, successful Takaful players in the market. But they need to adopt the right model, they need to adapt to the market environment, which is ever-changing, and they need to have some sort of value-added proposition. In the past, it's been, say, trying to have surpluses and distribute those surpluses back to policyholders, but they need to have some sort of identification. And I've just outlined a few points there in terms of what we believe in terms of what will enhance credit quality over time or reduce credit quality over time if companies cannot make it work. Distribution, having the right product is key. Making sure that they adopt the right model which shows that they have some benefit. I think conflict of interest is a big issue. Making sure shareholders and policyholders' interests are aligned is critical to making it work. Having the right balance of wakala fees, ensuring that the card Hassan is only used in emergency circumstances, and that they are showing that surpluses are there created to support the fund in the event of adverse loss development or to pay them back over time. And, I think the development of Islamic or Sharia-compliant investment markets will help to get some more diversification, reduce concentration in the market. And the way the regulatory regimes are going, I believe they are very different right now. But if there is more uniformity, more clarity, more transparency, that will also help. And I think lastly, and this is just generally, is if companies want to make it work, I think the management has to be good. The management has to be of good quality, and they need to make it work. I mean, you can take a good company, have poor management, and they'll go downhill. You can take a weak company, get the right people in there, and they can drive it in the right direction. So I'll finish on that, and I know I've done my allocation of time. But if we do have any, I could take any questions. Thank you.